Hello, Bismillahirrahmanirrahim. Welcome back to my channel, Learn and Grow with Faraz. Before starting my video, let me tell you, if you have not yet subscribed to my channel, you are requested to please subscribe this channel. This channel will be very helpful for the students of business studies, BBA, MBA, and my this video will be an addition in the playlist of business finance. If you are student of the aforementioned courses or fields, these videos and this channel will be very helpful for you. So you are requested to please subscribe my channel. Actually, I make these videos for students, and when a student subscribe my channel, he gets the updates whenever I make a video. So when he get the update, he actually is inclined to watch the video and ultimately he learns something. So my purpose is to make you understand the basic concepts of business studies and make you learn something. Okay, ji. We were actually discussing about financial ratios. In the previous video, we discussed about liquidity ratios. In this video, we will be discussing about financial leverage, are also called long-term solvency ratios. This will be our topic of discussion today. So what is my style of teaching? I will, especially for YouTube, I will keep on reading from the book and then I will explain the sentences for you. Why do I keep on reading from the book is, the reason is the students who are quite weak in business studies, they also get good understanding when the teacher reads from the book and explain it easily in his own words. And you can also pause the video, you can read the lines from the book, and then you can listen to my channel. And in this way, the video and the lecture will be very fruitful for you. So financial leverage are long-term solvency ratios. Long-term solvency ratios, they are often intended to address firms' long-term ability to meet its obligation, or more generally, it is financial leverage. How much financial leverage a firm has, or how much financial flexibility a firm show over a longer period of time, or how a firm is able to fulfill its long-term obligations. So these are actually discussed in financial leverage or long-term solvency ratios. The lower the debt ratio of debt equity ratio and higher the equity multiplier interest cover ratio. The debt to equity ratio, if it's lower, it means the equity multiplier is higher. What is this? I will tell you in the coming, you can say, in the coming sentences. The more liquid or solvent the company is in long run, less risk of financial distress in the long run. Like, company should not be having financial pressure in the long run. It should have less pressure in order to meet its long-term financial obligations. These ratios are of particular interest to banks and other potential bond investors or when bidding for long-term contract. These long-term ratios, these are uh, these are of interest to the banks. Banks are mostly interested in long-term ratios, or the potential bond investors who are investing in the bonds or who are actually bidding for a long-term contract. When they are going to bid for a long-term 5-year, 10-year contract, so these ratios are actually uh, they are actually interested in long-term financial ratios, or this, it's also called long-term solvency ratio. So total debt ratio. Total debt ratio, this is a sub part of this one, sub part of long-term solvency ratio. What is total debt ratio? You have to minus total equity from the total assets and divide it by the total assets. So formula is total assets minus total equity divided by the total assets. You get total debt ratio. The total debt ratio takes into account all the debts of all maturities to all creditors. It is what happens in the case of debt ratio. It considers all the debts of all maturities and to all the creditors. Maturity mean when a bond reaches or when a share reaches its maximum value, when it has to be converted into cash, it is actually the maturity date or the maturity time. Then debt to equity ratio, this is another sub ratio involved in solvency ratio, long-term solvency ratio, debt to equity ratio, its formula is total debt divided by total equity. In the coming videos, we will have short numericals where we will actually solve these ratios and we will solve those numericals. Then equity multiplier. Equity multiplier is equal to total assets divided by total equity. And next one is interest cover ratio or time interest earn ratio. Interest cover ratio is interest before uh, earning before interest and taxes EBIT divided by the interest. So you have to get the earning before interest and tax, and you have to divide it by the interest, so you will get the interest cover ratio. Operating profit is also this EBIT. This is also known as operating profit. So operating profit is also known as earning before interest and tax. When you have not paid the tax and you have not paid the interest, that is called your operating profit. This is another important term. You have to keep it in mind. As the name suggests, this ratio measures how well a company has its interest obligations covered and is often called interest coverage ratio. So, how healthy a company is in order to cover and in order to pay the interest it has to pay. So, how much it is able, how much it is strong to cover its interest obligations. So, that's why this ratio is also called interest cover ratio. Then cash coverage. Cash coverage ratio, interest before earning before interest and tax, plus you have to add the depreciation in it. What is the depreciation? The concept of depreciation says that a continuous reduction in the value of an asset. The reduction in the value of an asset is called depreciation. For example, when you buy a cell phone, the time you buy a cell phone, with the passage of time, its value reduces. That reduction in the value of the asset is called depreciation. So, earning before interest and tax plus depreciation divided by the interest. This is called cash coverage ratio. A problem with the TIE, time interest earned, with the passage of time, when you interest the earn, there is a problem with that. And problem is it is based on operating profit which is before the interest and tax, which is not really a measure of cash available to pay the interest, as we know, because operating profit is not a good measure, because this is before the paying of interest, the operating profit. The reason is that depreciation and other non-cash expenses have been deducted out. Because interest is definitely a cash outflow, one way to define the cash coverage ratio is like above. So this is another way, cash coverage ratio. You add the depreciation and you actually show it in the form of cash coverage ratio. The EBITDA, earning before interest, tax, depreciation and amortization, or the EBITD, earning before interest, taxes and depreciation, is a basic measure of firm's ability to generate cash from its operations. Actually, it gives a firm the ability to generate cash from its regular operations, and it is frequently used as a measure of cash flow available to meet financial obligations. So what happens as a result? The cash flow become available for the company to meet its financial obligations. So this is cash coverage ratio. Then turnover ratios or asset utilization ratio. We will start our next video from this point number 3. I will end my lecture here, and in the end of the lecture, I will once again offer you and I will once again request you to please subscribe my channel. This channel is going to be very helpful for you if you are student of BBA, MBA, BCom or MCom, or if you are even the student of accountancy, ACCA or CA, because this on this channel I cover very fundamental and basic. I use fundamental and basic language so that it is easy for you to understand. So you should subscribe to my channel. So I hope this served the purpose, and inshallah this video will be useful for you. Keep coming back to my channel. Thank you for watching.